Aloha and welcome to the Hawaii Financial Freethinkers Academy Financial Literacy Education Program for employers and employees. The name of this class is Cash Flow Management. So we're going to focus on cash flow management for individuals and family or households here. And this class is about 30 minutes. So before we begin, you should definitely download and print out the class summary quiz, and you can use the summary quiz sheet to take notes, and you can answer the questions on the quiz as we go through the class. When you've completed the class, send an email to highfinanceacademy@gmail.com, state your name, the class you just completed, and the date, and we will then email your completion certificate to you. To download the class summary quiz, click on the link in the description box below the video. Select the summary quiz corresponding to the class, download and print it out. When you have printed it out and you are situated where you can pay attention without distractions, you have a pen or a pencil, beverage of choice, and you're ready, please resume the video, and we sincerely hope that this and all the classes in the program will be of benefit to you. We welcome your comments. We invite your questions. You may email your comments and questions to us at the highfinanceacademy@gmail.com address, which is in the description box below. We will respond at our earliest opportunity. Please pause the video now and download your quiz.
Like karma chameleon, it comes and it goes. Cash flow simply refers to the inflow and outflow of money. Cash flow management is usually a terminology that refers to business finances, but the principles are largely the same as applied to personal finances. If we think of our household as a business, it may make it easier to apply a business-like mindset and discipline to our personal financial welfare. The purpose of this class is to help you understand principles of cash flow management that will enable you to achieve more of your financial and lifestyle goals, and how to apply them to your personal finances. Again, simply stated, cash flow refers to the inflow of your money and the outflow of your money. So to begin, we need to identify all the inflow, where it comes from, how much it is, and when it comes in. This includes, obviously, your paycheck. It also includes any income from any kind of rental properties. Could be real estate, but could also be, say, equipment or items that you may rent out. Rooms for rent in your home, parking spaces on your front yard for home games at the stadium. Do you have any kind of side job or hobby that produces any amount of income? Do you drive for Lyft or Uber on the side? Do you sell things on eBay or Amazon? Do you have a garage sale once a year or every quarter of the year? You get the idea, right? Once we have all sources of income listed and when and how much income is produced, then we have the cash inflow data. This is probably the easiest part. Next, we need to identify all cash outflow. This may be a little trickier. The obvious stuff like rent or mortgage, utilities including cell phone plans, cable or satellite TV, internet service, water, trash, etc. But be careful not to leave anything out. Because it's so automatic, sometimes it can be easy to overlook a regular bill we pay. Credit cards, for example, personal loans, etc. Do we have automatic payments set up that automatically deduct from our checking or savings account? We also need to include gas and mileage. This can be a little trickier, a little harder to track precisely, unless we keep all receipts for gas and always write down our mileage. Although there is an online program that can track it for you and figure the actual cost per mile. In fact, there's several. MileIQ.com is one that I've used, and there are several others that you can find online at Mileage Tracker Review. By tracking your mileage, you can get a tax deduction if you itemize. But for our purposes here, we want to know exactly what our costs are that our cash outflow is going to. Also included in the outflow are food costs, including every time we stop at a 7-Eleven for a musubi or soda. And whenever we go out for a meal or drinks for that matter, many people are shocked by the amount they spend in this way without giving it any thought. And that's why it's helpful to think of our personal or household as a business. Then there's clothing, household supplies such as paper towels, toilet paper, dish and laundry soap, and cleaning supplies, trash bags. You get the idea. There's a ton of things we buy for the home, right? Take your time, sit down with your spouse, and list every single little thing. This is important to get everything listed, the amount spent on them, and how often we buy them. I know my wife loves to buy little scented candles. I buy Scotch whiskey. Do you buy gifts for people? Do you have a business you run from your home? We do. So ink, paper, and other office supplies are tax deductible. So are charitable donations. All the more important to track these expenses. In any case, we want to get every penny that goes to our outflow accounted for. Once all the inflow and outflow data are written down, then we total each. If the inflow is more than the outflow, there's money left over after all costs are counted for, then we have a positive cash flow. If we break even, there's no money left over, we have a static cash flow. If there's more going out than coming in, we're in a negative cash flow. Unfortunately, more people are in the last two categories than in the first. But take courage. If you're one of them, there is hope, and that's why we're here. Basically, if we're in the static or negative cash flow categories, there are just two ways to improve the situation. One, increase our inflow, or two, decrease our outflow. While it may not sound all that appealing, probably the most doable solution for most is to decrease the outflow. But it may be easier than you imagine at first thought. Identify cash flow leaks. Identifying the outflow is typically the most tedious part of cash flow management for a household, but it is the step that makes the road clear to repair, so it's very worth the time and effort. I mentioned this a little bit ago, but the mindless, casual spending of money, especially on credit cards, for snack stops, after-work drinks with the buds, and the like, can be a huge drain. $100 can be easily spent on one dinner with the spouse at cattle company. On the other hand, $100 can also buy enough groceries for a week of meals at home with the spouse, and even a household of 3 or 4 if we're careful and don't go to the store when we're starving, or just go up and down the aisles and grab everything that looks good. If we plan meals in advance and make a list of items that we need for those meals, then stick to the plan when we're in the store, we can actually save quite a bit of money, which will improve the cash flow balance. Now, once we have everything listed and have determined if we're cash flow positive or negative, we can start to prioritize. Now we can see where the cash flow may be leaking and take measures to stop the leakage. As mentioned, those frequent stops at 7-Eleven for a quick snack or drink, especially if you're buying water, can easily be cut down by simply packing a small cooler with snacks that you prepare at home. And Buying water? Come on. We have some of the best water in the world here in Hawaii, supplied for free almost everywhere. And if you want to throw $1 away, throw it at me. Sheesh. And coffee? Don't get me started. $2 and more for a small cup of coffee? I know people who spend $25 and more per week just for 1 cup of Starbucks per day. I'm a bit of a coffee snob myself. I buy a 36-ounce bag of French roast beans at Sam's Club for $17. Grind it there to a fine Turkish grind, and brew a pot every day, 7 days a week. If I'm going to be out of the house all day, I might brew a little extra and take a thermos of coffee with me. That bag lasts us 3 weeks. I guess I'm saving about $170 a month right there instead of buying my coffee out every day. Now, if I have a meeting with a client, we meet at a Starbucks because it's convenient and they're everywhere. Sure, I'll buy a cup of coffee for us, and maybe even a brownie. But then it becomes a business expense and tax deductible. And it's not every day that happens. So the point is, we don't have to become super restrictive on ourselves to get our cash flow into a better balance. But we want to plug the unnecessary leaks. And that's why meticulously listing every single expenditure is so important. Then we can see where our money is going and identify things that we can cut back on without feeling deprived. Once we stop the leaks and see our positive cash flow improving and even getting some of the credit bills paid down and off, well, it feels more like we're rewarding ourselves instead of restricting ourselves. Here are a few websites that offer free budget worksheets that you can use to help you create your budget. Now we can prioritize and design a personal budget. One of the most important goals of cash flow management is to maximize available cash. One of the most efficient ways to do that is to design a personal or household budget and stick to it. When we know exactly where, when, and how much cash is coming in, and exactly where, when, and how much is going out, we can both prioritize expenses and design a budget that will help us to rebalance our cash flow and get it to a more positive place. This step is actually pretty simple and easy. We've already done the hard, tedious part. Now it's just a matter of putting it on paper or a spreadsheet. On the inflow side, list the sources of inflow, amounts and dates it comes in. Then, typically, we'll have 2 or more dates when we pay certain bills and expenses each month. List the total of inflow available on those preset dates. Next, in the outflow side, list the necessary expenses. That's where prioritizing comes in. After the necessary expenses are paid, if there's money left over, then we prioritize the other non-necessary things we like to spend our money on. But if there is a positive balance at this point, before we add back the things we like to spend on, we should dedicate a portion of that cash to savings. Statistics sadly show that more than 40% of working Americans do not have $1,000 in savings or even in available credit to pay for any kind of emergency that may come up. And you know they do. So let's be smart and create that savings account and build it up for that rainy day when you'll be glad you did. Eventually, part of that savings can become your reward account, where you can be guilt-free in rewarding yourself for doing the work and sticking to your budget and turning your cash flow around so you're in the positive. We mentioned this in the basic class about cash flow management, that it may be advisable to pay off a lower interest APR loan or credit card rather than a higher interest APR loan first. This would only be in the case where the lower APR loan has a higher minimum monthly payment requirement. Again, the idea is to maximize the availability of our cash. To do that, we need to do two things. First, get all the loan statements together and find out exactly what the APR is for each, and what the minimum monthly payment requirement is for each. Now, back to the budget plan. If you have a loan that has a minimum monthly payment of $100 and you typically pay $120, change that. Just pay the minimum. Budget that. Now, take that $20 you usually overpay and put it into an interest-bearing savings account. We'll talk more about that in the class on the tax-free cash growth warehouse. If you have more than one loan or credit card that you typically overpay on, do the same thing with each. Just pay the minimum and put the overpayment into that interest-bearing savings account. Now, when you have $100 or $200 accumulated in your savings account, take that and pay it on the principal of the one loan that has the highest minimum payment requirement. Doing that will lower the amount of interest being added to the loan balance and should also lower the minimum payment requirement. Then go back to paying just the minimums and putting the overpayment amounts back into the interest-bearing savings account. Accumulate another couple $100 in there and repeat the payment to the principal of that first targeted loan. Keep doing that until that one loan is paid off. Then you can work on the next loan and get that paid off the same way. Of course, when you have that first loan paid off, put the whole regular payment that you used to have for that loan into your interest-bearing savings account. You can see how much faster money will accumulate then, and how much faster you'll be able to get all your other loans paid off one at a time. What we've just described is referred to as the snowball strategy. And then you can put all those former loan payments into that emergency reward savings account and go have a little splurge on a reward. Yeah! It is practical and of great value to monitor how we're doing with sticking to our budget on a monthly basis. It is recommended to keep all your records for the month and at the end of each month, categorize them and compare the totals with your planned budget. If you have a good month where you actually spend less than you budgeted for, put that extra savings into your interest-bearing account. If you slipped up and spent more than you have budgeted, check with your spouse and see what you can do to get back in line. Here are a couple more practical things that you can do to help you on the way to financial success. Because FICO, which stands for Fair, Isaac & Company, the company that the credit bureaus use to secure a credit score, is important for us to obtain credit for all kinds of things. Even employers often will check on a person's FICO score when considering employing them. It is sometimes used as an indicator of a person's responsibility and reliability, whether that's fair or not. It is the case. So one thing we can do is sign up for an account online with creditkarma.com. It's free and allows us to access our FICO credit score anytime we want. And credit cards and some other credit loans do report our activity every month. One of the important factors used in assigning a credit score is the ratio of credit used to the amount of credit we've been granted. This is known as credit to debt ratio. Let's say we have 3 credit lines, cards or others, and the total of our credit limits equals $30,000. If we have all our credit maxed out, that doesn't look real good to the credit bureaus, even if we always make our scheduled payments on time. If we have $30,000 of credit and only owe $10,000 on those credit lines, that looks good. So that would give a higher FICO score. On the other hand, even if we have that better credit to debt ratio, but we're slow about paying our monthly bills, that will result in a not so good FICO score. The lesson here is we want to make our payments on time and get our credit to debt ratio under control. Now, many people think that closing a credit account after paying it off is a good and right thing to do. But actually, as long as there isn't a fee for keeping an account open with a zero balance, it's better for your FICO score to leave it open because it gives you a better credit to debt ratio. Many people are not aware that you can request a higher credit line from your credit card companies. You can also request a lower interest rate or APR from them. They may not grant it to you, but depending on your record with the account, they very well might. And it never hurts to ask. If you don't ask, the answer is always no. All you need to do is call the credit card company and ask for a higher limit and or a lower APR. If they decline your request, ask them to tell you how you can go about getting a yes to your request. It may be simply a matter of continuing to make regular on-time payments for another 6 months. In many cases, that is all it takes. If you've had the account for over a year and you've always made your payments on time, and the phone representative declines your request, ask to speak to the supervisor. When the supervisor gets on the phone, ask them for the increased limit and or lower APR. Always be nice and friendly when asking for these adjustments, and express appreciation for their consideration. As the saying goes, one catches more flies with honey than with vinegar. Well, what will this do for you? If you get a higher credit limit and don't proceed to max it out, it will improve your credit to debt ratio and enhance your FICO score. If you just get the lower APR, it will decrease the rate at which your debt increases, which is always a good thing. And it will help you to pay the balance down faster. One more thing a lower APR may do for you is other credit companies will see the rate that you're given. Then they may offer you a credit line at a similar rate and a period of zero interest for you to switch to their credit card. And this can be a really good thing. Obviously, if you can get a zero interest rate for 12 to 18 months, that'll give you that much time to work on paying down the debt without having more interest tacked on. Of course, if you're able to transfer some or all of your credit balances to a zero interest line, that will also improve your credit to debt ratio and move you closer to a higher FICO score. Well, this brings us to the close of this class. If you would like more information on cash flow principles, there are resources online, and there's the Robert Kiyosaki book, Rich Dad, Poor Dad. If you would like our help in implementing any of these strategies I covered in this class, feel free to contact us via email or phone, and we will be happy to help you out.
Our next class is on the personal sweep account strategy. That will arm you with another tool that you can use to accelerate the paying off of debt. The third class in this program is on how you can establish and use a tax-free cash growth warehouse account and strategy. That strategy is by far the most powerful and versatile of all finance strategies. With it, you can multiply the effectiveness of your personal sweep account as well as your cash flow management strategies. Now, if you have questions about the cash flow concepts we've been talking about, please email us and we'll be sure to respond. Now, please fill in the class summary quiz if you haven't already, and email us that you have completed this class, and we'll send you the completion certificate also via email. Next up is the personal sweep account and strategy. See you there.